Have you ever wondered why the Dodgers payroll is so much higher than basically every other team in baseball? Well, the source of that is revenue inequality. For some context, the Dodgers make just around $750 million a year in revenue. Compare that to the A's, who make just around $250 million in revenue. There's no way salaries can be fair and compete with that level of revenue inequality. My name is Mike Whitmire. I'm the co-founder CEO of FloQast, inactive CPA, and massive baseball fan. And at FloQast, we love accounting, we love finance, we love sports. We, and myself personally, are very concerned about a labor stoppage as a result of the upcoming negotiations. So we wanted to film a series where we put some of our thoughts on paper, try to help with that entire process. To do that, I did hop on eBay. I was able to find some light reading here. We have the 2006 Major League Baseball basic agreement between the Players Union and baseball itself. Light reading, my daughter has really enjoyed this one for the last couple of months here. And for the purposes of this series, it is very important that I am objective. I am not a Dodger fan for the rest of the series. I am a baseball fan. I want to make sure baseball continues and is a great sport for us to watch. So with that in mind, I'm going to take off my Dodger hat here and flip to my MLB hat because our goal is to make sure baseball is successful. So what's the source of this problem in baseball? The reality is it's not that owners are greedy or they set it up this way. The reality is baseball is the oldest professional sport in America, and it was created before TV rights were even a thing that were considered. And the way the sport has evolved is each team has owned their own TV rights, which has driven a significant amount of revenue inequality across organizations. You compare that to the NFL, they do not have local rights. Everything is nationalized, it's central, and every team gets a fair distribution of that revenue. So that is the source of all of this. It's because baseball is our pastime. All right, so we are admittedly diving into a really complicated topic. We're going to cover a variety of areas over the course of this series. Make sure you subscribe to see all of that. So welcome to MLB Econ 101. Let me start by addressing the elephant in the room for this section, which is there's not a ton of financial transparency as it relates to MLB clubs. So everything I'm using, they're estimates. They are not auditable. However, directionally accurate and very helpful for us to have a conversation here. So just want to have that caveat before we move through the rest of the series. Let's start by taking a look at the actual revenue for the various MLB teams. So you can see on the screen here, the Dodgers north of $750 million of revenue, Yankees closely trailing them. You go all the way to the bottom, you have teams like the Rays, the White Sox, and the A's, sub $300 million of revenue. That's a big problem, something that we need to get sorted out. And later in this episode, we're going to do a little bit of a deeper dive on three of these teams. We're going to look at the top end with the Dodgers, the bottom end with the Marlins, and then right in the middle, we have the Atlanta Braves, where there is the most financial transparency because we can look at those publicly traded SEC filings to grab financial information from them. Now, within those revenue streams, how are we making money? Let's take a look at MLB itself and understand where all the different money is coming from. Okay, let me walk you through the 7 main ways MLB makes revenue. For starters, we have national TV rights and we have MLB.TV revenue. That accounts for $3.25 billion of revenue there. Second is local TV and regional sports networks revenue. That's $2.95 billion. This topic is pretty complicated and super important, so we're going to dive deeper into this one in a later episode. Then you have ticket sales. We all pay to go see baseball. It's awesome. That revenue accounts for about $2.5 billion. Then you have concessions and parking, and then it starts to drop off here. Concessions and parking about $1.2 billion, sponsorship and advertising about $1.1 billion, licensing and merchandise $850 million, and finally postseason gate and events is about $400 million of revenue. You pile all that up, and MLB made about $12 billion of total revenue in 2024. And for baseball fans, what's really cool is that number grew from 10 to 12, from 23 to 24. So baseball is thriving, baseball is growing. We should all be really excited about where the sport's going. So those are the 7 main revenue line items. Let's do a little revenue sharing 101 for each of those line items. Again, we'll take it from the top with national TV rights and MLB.TV. Those numbers are evenly distributed across every team. So just take the total $3.25 billion, divide it by 30, send that to each of the clubs, and that's how that one is shared. Super simple. Then it gets a little more complicated. You have local TV rights fees. This is where we move into the labor negotiation definition of baseball-related income. So this is now income that's generated by a single team. For example, the Dodgers have a TV contract here in LA with Spectrum. Spectrum has paid the Dodgers $10 billion to have those rights over a 25-year period, which equates to about $340 million a year in revenue. That $340 million in revenue is generated by the Dodgers qualifies as baseball related income. And as such, 48% of that is then shared with the rest of the league. So that's how baseball related income works. Ticket sales are next. That also counts as baseball related income. So 48% of that is shared with the rest of the clubs. Then it gets a little more nuanced. You move into concessions and parking, 1.2 billion. Some of it's shared, some of it's not. There's adjustments with expenses, gets a little more in the weeds there. Then you have sponsorship and advertising. That also qualifies as baseball related income. So 48% of that is going to be shared. Moving into licensing and merchandising, this is purely shared revenue, similar to national TV rights. You take the licensing merch number, divide it by 30, and share that across all of the teams. And then finally, we have the postseason gate revenue. Small line item at only 400 million of revenue there. There's some nuances around how it's shared. It's split evenly with teams and players to establish the bonuses for winning the World Series. So a little nuanced there. Some of it's shared. For the most part, it's not. It's league controlled. I've been throwing a lot of numbers at you. Let me show you what this looks like for 3 actual teams. So the 3 teams we're going to cover are going to be the Los Angeles Dodgers because they have the most revenue. We'll take a look at the Atlanta Braves as well. They are a publicly traded company, and so we're able to access their financial statements and do a deeper, more accurate dive on their revenue streams. And then we'll also cover the Marlins because they are on the lower end of the range. They're a big recipient of revenue sharing dollars and aren't necessarily spending those dollars on salary to put a good team on the field. So we want to break that one down in a little bit more detail. Let's take it from the top with their national media revenue. You can see, as I mentioned earlier, this is distributed evenly. So each of these teams receives just over 100 million in revenue from the centralized revenue source that is MLB.TV and national TV contracts. Then we move into the inequality. Local TV rights, you can see one of the biggest discrepancies here. The Dodgers make $332 million a year from their deal with Spectrum. Beyond that, they also co-own the network, which is called Sportsnet LA. They do all the producing of the games. They have a great post-game series. They do Dodger retrospectives, all that stuff. Dodgers own 50% of that entity, and so there's some value within there as well. But from a pure revenue perspective, just over $330 million a year in revenue from that. The Braves, comparatively, make about $110 million in revenue from their local TV deal, doing pretty well compared to other teams. Conversely, the Marlins are only making $53 million a year from their deal. So you can see here, we have a big range in revenue from $53 million up to $332 million, extreme source of revenue inequality here. Then you have ticket sales, also a big source of revenue inequality. It is not cheap to go to a Dodger game. They sell a lot of tickets. It's a big stadium. And so with that, they make about $365 million a year in ticket sales, according to my estimate. Moving down, Braves also sell a lot of tickets. I'm sure not that cheap to go to a Braves game. So they're at about $210 million in ticket revenue there. And Marlins, on the other hand, pretty cheap to go. They're not selling a ton of tickets. They're down there at $42 million in revenue from their ticket sales. Continuing down, then we have concessions and parking. We are now moving into a territory where I am estimating a lot of revenue here. So I put this schedule together. These are not going to be auditable. However, again, directionally accurate. When I take a look at this, my guess is the Dodgers make about $100 million a year in concessions and parking. The Braves also doing well there. People buy beer in Atlanta. They're spending about $95 million a year on concessions and parking. And then the Marlins, because of lower attendance, not quite as much. So we have them down at $20 million there. Sponsorship and advertising, again, you're able to make more money if you have bigger talent and a bigger audience. And so with that, in large part due to the Japanese market, the Dodgers are able to command a big ticket for sponsorships. Thank you, Shohei. Because of that, the Dodgers sponsorship revenue is about $200 million a year. Braves also doing well at 120. Then you kick down to the Marlins and you can see down to $55 million from there. Licensing and merchandising, mentioned earlier, this is evenly shared across all teams. So you can see all 3 teams here got about $60 million in revenue from licensing and merchandising. Now we move into the revenue sharing part of the equation. This is where they are giving money to other teams. So when you take a look at the Dodgers, because of that revenue inequality around the regional sports network and ticket sales, they have a big bill at the end of the year. Pile luxury tax on top of that because they spend so much on salaries. You end up having to share $430 million a year with the rest of the league. So you add everything up, the Dodgers are sharing almost $500 million with the rest of the league. Pretty wild when you think about it. Comparatively, the Braves, they have to share about $211 million. And the Marlins, they do have revenue that's baseball-related income and has to be shared. Their bill is about $72 million a year. So here you can see The inequality with the revenue certainly plays out in how much of that is shared, but it's not shared enough to really create fairness across all the clubs there. So you keep moving down how much revenue is shared with each organization. They get just over 100 million, 106 million per year from all that pooled revenue. Then I move down, I add all of that up. What is the total adjusted revenue for each of these teams? The Dodgers are 860 million, the Braves 598 million, and the Marlins 372 million. When all the dust settles, we shake out all the revenue sharing, we have our revenue sharing receipts. These are the numbers we arrive at. All right, we can do some things to drive fairness across more of those revenue line items. Some of them we can't. Ticket sales, for example, no one can make the Dodgers charge less for tickets. You can't ask them to sell fewer seats. It's just not going to happen. So tough to fix over there. However, TV rights, there's a big opportunity to drive more fairness on that side of the equation. I'm not the only one who feels that way. Rob Manfred has a stated goal to acquire all TV rights for all 30 MLB teams and centralize it by 2028. Here we are in 2026. 2028 is not that far away, and there's some big contracts out there. I'm really curious what his plan is to make that happen. But I agree with him, and in my proposal for driving more fairness and an MLB labor negotiation, I'm going to cover off on my plan for making that happen within that episode. Now, as part of the negotiations, salary cap versus luxury tax is going to be a big point of debate. But did you know that because of the luxury tax, we effectively have a salary cap today? Let's start by understanding the history of the luxury tax. So it was first introduced in 1997. This was an experiment. Quite frankly, it was driven by the Yankees spending so much more than everybody else. They were the original evil empire. And so we thought there has to be a way to cap this. And players are dead set on never agreeing to a salary cap. So they decided to change the name of it to a luxury tax and try to really cap how much money teams are spending on players. It's had some good results, not perfect, obviously, but it has been more helpful versus a world where we had nothing put in place, right? Then in 2002, the modern CBT was introduced. In 2012, it was rebranded as the competitive balance tax, and higher penalties were applied to it at that point. As part of the 2017 labor negotiations, the threshold for growth slowed down, which had a really negative impact on players, which we'll cover in a little bit here, but that effectively created an even tighter salary cap for the league. And then in 2022, as part of those negotiations, the ownership group that was pissing everyone off at that point in time was Steve Cohen, spending a ton of money. So the Cohen tax was introduced, which was an extension at the highest level of how much teams are spending on revenue. So that's a little bit of the history. As we look at the 2026 negotiations, this is a key point of contention between the players and the owners, driven by the Dodgers right now. But we have a long history of different organizations driving this conversation. The Mets, the Yankees, and the Dodgers are all big contributors to this point of debate here. The thresholds for luxury taxes are changed as part of the collective bargaining agreement each time. So coming out of 2022, what did those look like? We started with 2022 and a base tax threshold of 230 million. So if you're spending more than 230 million on your payroll, you are subject to penalties. Then there are thresholds above and beyond that. So you have a first threshold, which in 2022 was 250 million. You have a second threshold, which was 270 million. And then you have the third and final threshold, which is 290 million. Those numbers all go up each year to be inflation adjusted. So by the time we hit 2026, the thresholds are going to be 244 for starters, all the way up to 304 for the third threshold there. So how do the taxes work within each of those thresholds? When you hit the base tax rate, anything above that is subject to a 20% luxury tax. That's the starting point. Then as you move up thresholds, there are incremental penalties on top of that. So after you hit the first threshold, anything above that up to the second threshold has an additional 12% penalty applied on top of that. When you hit the second threshold, anything from the second to the third threshold has a 42% additional tax on top of that one. So you add the 42% plus the 20% base rate, you're talking 62% in tax being applied on top of that. And then once you hit the third threshold, that number goes all the way up to 60%. So 60% plus the 20% base rate, you have an 80% tax that you're paying on any salary above and beyond that third threshold. This all piles up to be a lot of money. Certain teams can afford it and it's not a problem. Many teams went over the threshold there for 2024. We expect that to continue in forward-looking years, but it's pretty punitive when you get really high above the thresholds. If you're a repeat offender going way above the threshold, at some point it ultimately does impact your draft abilities. So Repeat offenders, if you're over the second threshold, whatever draft pick you get is then actually dropped down 10 places from MLB as a little bit extra punishment for you spending so much money. All that said, there is protection. If you have a top 6 draft pick, you're going to stay within the top 6. You're not going to get dropped down to 16 from there. They will protect that. I will say if you're spending this much money and you have a top 6 draft pick, things are not going well for you and you got to get that sorted out though. So we've been talking a lot about the teams, how they make money, how they share their revenue, how they're penalized via the luxury tax, but what has the impact on the players actually been? And that to me is really fascinating. When you look over the history of the collective bargaining tax and the luxury tax, it's actually had a really negative impact for players, particularly when you compare it to how much money players in other leagues are getting. So diving into that a little bit more, when it was first introduced and first codified in 2002, MLB players were making out really well from it. They ended up making about 56% of the league's revenue in the form of player salary. You compare that to other leagues that were generally in that 50 to 55% range, Major League Baseball players were taking home the highest percentage of overall league revenue, which at the end of the day is what players are looking for. They want a high percentage of the league revenue. They want that in the form of salary. However, what ended up happening was the other leagues ultimately did agree to salary caps or luxury taxes that were so incredibly punitive that they do genuinely act as salary caps. Other leagues went in that direction. They agreed to it. And in general, they would say, hey, we want 50% of the revenue allocated to player salaries, and that's how we arrive at the salary cap. That's the general rule of thumb. Now, baseball players, because they agreed to the luxury tax system, there's no requirement for teams to spend a certain amount of money. There's no salary floor that comes along with that. And so what we've seen in baseball is baseball revenue has actually accelerated significantly. Baseball players' salaries have not kept up with that same revenue acceleration. And so today, baseball players, compared to other leagues, actually make the lowest percentage of revenue in the form of salary. So for context, back in 2015, this was at its lowest point. Baseball players were only making 38% of league-wide revenue. That number has come up over the last 10 years. Today, they're at about 47% of league-wide revenue. But still, of the major sports in the United States, they do make the lowest percentage of revenue in the form of salary. So the players making less money than other leagues is a problem in and of itself. But to me, the bigger issue here is that it really has led to a lack of trust in the owners. So if I put myself in the player's shoes, it's like, hey, when we started negotiating this, I thought it was good. And then something happened, revenue went up, and all of a sudden we as players are making a much lower percentage of league revenue. That's not a good spot to be in. You pair that with the owners not being transparent about their financial statements and not wanting to share that information. And I can understand why players do not trust what owners are saying and are very skeptical of any proposal. So to me, for us to have really effective negotiations over the next year or so and make sure we don't miss baseball in 27, we have to start from a point of trust. I would encourage players to let go of the past here. I would encourage owners to be transparent about their financial statements and share that information so we can be collaborative and come to an agreement within a reasonable amount of time. So now you understand the basics of MLB economics. You see we have 30 teams making wildly different amounts of revenue. We have a little bit of a revenue sharing agreement that has helped but has not solved the problem completely. And we need to think really holistically about this. Over the course of this series, I'm going to break down several key topics that will help with labor negotiations to ensure that we do, in fact, have baseball in 2027. We'll start by addressing the very biggest topic that's going to be on the table for these negotiations, which is a salary cap versus a luxury tax. I would like to be 100% clear. There will not be a salary cap in baseball, and that's actually because of the owners. We need to address that early and get that off the table. My concern is that the players' inability to agree to a salary cap is going to be used as a reason why we can't get negotiations going sooner. And we as fans need to understand why there simply will not be a salary cap based on current revenue structure, whether you like it or not. We'll dig into that in a later episode, but if we can knock this issue off the table, then we can proceed with effective negotiations around how we can make it fair for both sides of the table going forward. We'll start by discussing two major loopholes. Everyone loves a loophole. We have one that's being used by big market teams. We also have another loophole that's being used by small market teams. Both of those need to be addressed. I'll dig in deeper on a new wrench that's going to be thrown into these negotiations, which is gambling revenue. The last labor negotiation does nothing to define any of the rules around gambling related revenue. And from my perspective, this is a really important topic because not only is it revenue related, but it impacts the players in new ways that we have not seen players impacted. We've had scandals around players participating in prop bets. It's impacting on-field play. We also have player safety issues because fans are losing money and blaming it on the players. There are a host of items to be considered within the gambling revenue wrench, and we'll dig a little bit deeper into that one. Then one of my favorite portions, we did a couple interviews to help us get the perspective of players, how they think about things, and also the perspective of owners, what they care about and how they think about things. And finally, we'll wrap up the series by presenting my proposal on how we can have an effective agreement that will make owners happy, it will make players happy, and also be more forward thinking. I want to think about the future of baseball and how do we really set baseball up for success in the year 2050. We need to be thinking about these things today because we all love baseball and we want to make sure it's a thriving sport and we can watch it for the next 100 years. So if you love baseball, are interested in the finances behind the sport, and want to be part of the conversation, don't forget to subscribe to our channel.